We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. This is part 2 of the power of a simple moving average. We're going to show how this relates to Wyckoff and A logic, and also look at examples with Apple and Bitcoin at the end of this discussion. The composite man, to measure the price move, uses the most simple tool. That would be the weekly simple moving average. The retail trader must discover which simple moving averages are the mass of the price move or momentum for each security they're looking at. It's not the standard 50 or the 200 or the 100. They work for some, but they don't work for all. You have to find which moving average period fits the price action of the chart. The reason why every chart is different is because the order execution of size is different in every trading pool. Okay, some stock symbols, it's easy to get $100 million worth of shares traded in an hour. Other charts it takes several hours or weeks. So the liquidity of each stock is different. So therefore the behaviour of the stock will be different. Therefore moving averages that work in each stock will be different. So what you have to do, you have to start off with simple moving averages, starting any average ending with a 0, like 10, 20, or any average ending with a 5, 25, 55, 75, 125, to see which best fit the chart. Okay? All the way up into 6,000. I was showing in part 1 where the Dow Jones actually uses the 6,000 SMA. Okay. Now what we must understand is large traders cannot accumulate stock float while price is advancing. Otherwise they'll just be pushing price up against themselves and be trying to accumulate while price is going up, and that'll just make their cost average worse. They must accumulate on a downswing. Now the downswing form and nature of a downswing is a mirror of how much demand there is. If it's a nice tame pullback and it's controlled by a fast moving average, you can tell there's pretty good demand. But if it's more of a panic, there's some panic selling going on, or what have you. The retail trader must determine which simple moving averages are the master of the price move or master of the momentum. Knowing the master simple moving average in relation with your Wyckoff with your Wyckoff logic of accumulation, what have you, helps you. A lot of helps determine the cause. So you can find a good accumulation pattern sitting on a well-respected simple moving average. A good chance that demand is coming in at that level. Also, you have to decide when a master simple moving average, or the one that's in favour, becomes out of favour. I mean, they're in simple moving averages can be in favour for 2 years, then they break, and when they're not in break. So I would suggest you look at the number of closes, weekly closes, on the cross of the moving average to suddenly say, well, this is a weaker situation and the moving average is out of favour. So here's a quick possible how-to to find the master simple moving average. You're going to need a lot of data if you're looking at weekly simple moving averages. You're going to need 15, 20, 30 years of data of the stock price or the index. The reason why I say weekly, because in my research I find that weekly is better than daily and it's better than monthly. So it shows that this is the best test to find which periods are holding to the composite man's truth and how they are monitoring price movement. Okay, first you go through and identify major, intermediate and minor weekly pivots. You synchronise, or you get an idea what your out of favour all is, or when the moving average fails. Might be 1, 2, 3, 4 weekly closes below crossing the moving average. Set up a bunch of simple moving averages on a few charts, a few scans, and you might set up a moving average that goes from 12, oh sorry, 15, 25, 20, 50, 100, 150, 200, 300, until, and just have an idea to scan it. We'll see which ones are working. I mean, I have movement averages from 12 to 6,000 on 3 different scanners to find out which ones fit. And the reason why I do that because each stock is different, as I said before, because each stock has different liquidity issues in getting large orders filled. Very liquid stocks like Apple are very tight because they can get lots of orders done with high volume in a quite a narrow range. Other stocks can be much wider, like Ford or was it Walmart or something. Obviously the ranges are a lot wider, so therefore the same moving averages won't fit each chart. The generic 50, the generic 100 will not work on every chart. You have to find the ones that show which ones are the master of the price move, which simple averages are the master of the price move. Okay, so once you work out the pivots and you find out which moving averages hold to those pivots, the bigger the pivot, more likely to be a longer moving average, and the smaller moving average will fit the smaller pivots. Okay, and you might find a moving average will be in favour for 2 or 3 years and out of favour 1 year, then the market starts trending again and it's come back in favour. Whenever you find favour for a moving average, the master moving average, keep making note of it because it may come back in favour after it's out of favour. Downtrends and uptrends are the same. Of course, once you find these master moving averages, they have other uses. You can put, once you can put a percentage band on top or underneath it. That's just like a channel. You can work out, the oversold and overbought areas. Okay, so once we've got that, you can also use your D20 price oscillators. Let's say you find a master moving average for a particular stock is 75. You can put that into a D20 price oscillator and use that to show you the revert to the mean studies. And obviously it works well with cycles and your logic. Okay. I can hear all the Wyckoff traditionalists out there saying, listen, there's channels and trend lines, that's the way you go, it's what they've been using for years. Well, there's nothing wrong with trend lines and channels. Unfortunately, to draw a trend line you need 2 points, and for a channel you need 3. However, a master simple moving average approach with bands is a lot easier to scan charts quickly to see what's coming in. I'll show you examples of those. And it does work. You should be surprised how well it does work. Just give it a go. Have a look. Now, I've referred to Wyckoff logic. Not all charts show the presence of the composite man. Some charts just a mess. You can't see any accumulation going on. So, if I would suggest you go along to the information frequently asked questions, and go along to the for the indicator library area, and scan down for this title, and go through those videos and find charts which fit into those parameters. Take into consideration you want to find Wyckoff friendly charts that show cause and effect. Okay, here's an example. This is Apple. Now I've got a weekly chart here. So I say the most powerful or the master SMAs that I find attractive. I got this going from back to 2005. I've got data going back to the 1990s, but we're just as good enough at the stage. All the major investment price decisions can be made around these master SMAs, right? We've got accumulation. We do a Wyckoff accumulation here. Accumulation. You get your selling climaxes and your signs of strength and your tests and your automatic reactions around here. It just so happens they fit on the 250, the blue line, and the 200 weekly SMAs. You can see that. So knowing that these long period weekly SMAs are there, these master SMAs, assist you in knowing that you have concrete or rock as your foundation. Okay, so when you're seeing the demand coming in here, and you know that a master SMA is underneath you from previous history, that's where the demand has come in. It adds metal to your bones that you're making the right decision to get long to prove that this is accumulation. And on a faster reaction, we've got the 25 week. You can see the 25 week here, caught all these continuation patterns. And a lot of people, you know, they bought here and they got out here thinking that was the end of the move. But they would have found that the reaccumulation pattern with the 25 weekly SMA would have kept them in. Okay, with a few tests here, you know, a bit of weakness, but depending on your, you know, you would have got back in on the breakthrough. And you can see the almighty breakdown here, and the moving average starts again here. You see how it jumps up here? Now the 25, you know, other charts it might be the 30 week, and other charts it might be the 20 week. I'm just saying, taking it into account. As you can see here, it's starting to get weakness here, breaking it. You have to be pretty forgiving to continue that, so we're watching that. Now, I've got the 75 week here as well, because the 75 week shows a couple of critical points back here in 2006, 2008, and you see it broke here. When it broke here, it fell away. Was the final test here on the 75, final test here, final test here. So the 75 has been pretty critical in the history of the Apple chart. So these four weekly SMAs I would call the master SMAs of the price momentum of Apple. So when I'm doing, because I basically want to be long mostly, I'm looking at accumulation and reaccumulation patterns, and I want to see them hold these master SMAs. I use the word master because these are the simple moving averages which are showing the measure of price momentum. And as you can see, the distribution obviously breaks them. Distribution breaks, LPS breaks, LPS 375. It's a lot harder going short. I like to do the longs. Okay. And here we've got a close-up. So at the moment, this is a weekly chart here. Sorry, weekly chart with the weekly SMAs on it. This chart here is a daily chart with the weekly SMA on it. We have the ability to draw timing into what do they call it? We can draw a weekly SMA on daily price data. Yeah, that sounds pretty good. So here we've got the same information but closer down, so we can get a lot. We can look a lot in depth of what's going on. Okay, so we can see our selling here, automatic reaction, secondary test, strength, LPS, all above this action here with our master SMAs. Okay. Now I've got a situation. I've got my what I've got here, my 25 weekly SMA on my price on my daily chart. Just like those channels, you've seen this before in the Wyckoff education material. The show when price falls away from a channel. Bob Evans would say that the seashell dive is not getting up against there; it's getting weaker and weaker. So when price goes from the 25 EMA up to the top here, it's good demand because people are buying up to the highs because they know at this point it's still going to be higher in the future, so they buy up large. But here they get disappointed because the price does not go up here. So that is demand is weaker. Here, these 2 points, demand is strong, demand is weak because it fails to get back up to the top like it did in these previous two. Falls back down to this band down here. It's of the 15%. I've chosen 15% because it fits, not because I use that number all the time. Other charts it might be 20% or 30% or 10%. So we find the supply is strong here because it gets down to that band, and the supply is strong again down here because it gets down to the band here. But supply becomes weak because it can't get down to the lower band because demand comes in and stops it. This is how our little accumulation pattern with some strength gets the upper band, the same place it was over here. So demand is strong, demand is strong. And as we can see, demand is weak again, or so far it is. It didn't get to this point here. Demand is weak. So we're doing a sideways pattern here, so we have to be careful what's going on here. And we're covered a couple of serious breaks of the 25 SMA. So just like the channel logic you use with Wyckoff, you can do that with the master SMAs or simple moving averages when you know which moving averages are a measure of the price momentum. What else we got here? Oh, yeah, we've got Bitcoin. So here we have, I'm looking at Bitcoin. This is a weekly Bitcoin chart. This is data from Bitstamp USD. I've only got back to 2010 or 12, what have you. As you can see, I've got the 12, the 50, the 20, and the 250. 250 covers this bear market down to here. You can see this little line here would cover those two pullback points. The red is the 50. As you can see, the 50 holds this trend well. It breaks through that, gets back in there, and as you can see, it's holding this point here. So it's been 50 SMA hold some critical points, and the speed SMA is 12. I mean, 12 times 2 is 24. I say 50, 25. So 12 is a subset of 50. Okay. I can't do moving averages of 12.5, so it has to be 12 or 13, so we're using 12. And as you can see, the speed moving average is pretty good when the thing gets going. So here we got situation where I better go to the close-up. Here's the close-up. As you can see, it works, and we want to see price get above 8,700. Now we want to see price hold at least 7,000 or 6,800. Okay. So we're challenging the upper end. So that, and obviously this you say, where does the price stop? The price stopped on the 50 weekly master moving average. I use the term master moving average because this is where demand has stepped up and got into defend the price action. So once again, the power of simple moving averages is to determine which moving average are the master of the price momentum or the price move, in which the composite man is using as critical price levels to show their hand. Thanks very much for watching.